Hello and welcome to this episode of Mic'd Up. I'm Pete Seiler, a part of our business development team here at iCM. And today I'll be joined by Ryan Lehman, iCM's Director of Investments. Ryan, thanks for joining us.
Hi, Pete. Happy to be here.
So for the last episode of Mic'd Up, our colleague Mike Bisciotti joined us and gave us some thoughts on what we're seeing into 2025. He touched on closed-end funds, but given their large component of iCM's tactical income strategies, I was really hoping to do a little bit of a deeper dive in this month's video. So why don't you start with a summary of 2024?
Yeah, absolutely. So despite a little hiccup we saw in Q4, closed-end funds had what I'd consider a pretty stellar year. So just looking at kind of where we started, the average fund entered 2024 trading at a discount to NAV of just a little bit over 9%. And we ended 2024 with an average discount that was just inside of 6%. So on a whole, discounts narrowed by right about 350 basis points or so. And I think that the key question is what happened last year? Well, if we think about the drivers of closed-end fund discounts, there really tend to be three primary factors: interest rates, credit spreads, and equity market performance and volatility. So let's take them in order here. So in terms of interest rates, it wasn't necessarily a supportive environment as rates were pretty volatile throughout the year. And most notably in Q4, we saw the yield on the 10-year Treasury rise by almost 100 basis points as markets took all those expected interest rate cuts off the table. And this left the benchmark yield about 50 to 60 basis points higher on a year-over-year basis. Credit spreads, our second factor, were a bit of a different story. Here we saw the spread on high yield bonds decline pretty meaningfully. Started the year around 330 basis points. We hit a low of about 250 basis points in November. And then we ended the year just shy of 290 basis points after a little bit of volatility in December. And then lastly, equity markets. Here we all know S&P had another strong year. It was up 25%. This was its second consecutive year of 20+% gains. And then volatility, also pretty tame. We saw a few spikes throughout the year, but on average, the VIX was around 15.5, which is pretty well below the 5-year average, which is closer to about 20. So I guess where does this leave us at year end? And I've got a slide to share here just to visualize everything.
Great.
So Universe trading a bit on the cheap side of fair value. It's about 6% of a discount to NAV versus the long-term average, roughly 4.5%. And then if we were to dig into the major asset classes, in particular fixed income, taxable bonds here, you finished at roughly 2% below NAV, so pretty tight. But if we look at muni bonds are trading at 8.5% below NAV.
All right, Ryan. So I want you to expand on that a little bit. Taxable bonds and municipal bonds are, obviously both fixed income assets. Why did we see such a large divergence last year?
Yeah, this is a really interesting divergence, and historically, you've seen a pretty tight correlation between these asset classes. In fact, if we look back historically, and I've got another chart here that I'm going to try to share. So the only other time discounts really disconnected was towards the end of 2015, but it was in the opposite direction. So we saw taxable bond discounts gap out due to concerns about that the debt of those junk-rated U.S. energy companies, while muni bonds actually held up pretty well. Today, you're kind of seeing the complete opposite, and I think the rationale is pretty straightforward. So taxable bonds tend to be more credit-focused investments, and as a result, their discounts and their NAV performance, they're going to be really highly tied to credit spreads, and credit spreads are really just a stone's throw away from historic tights today, despite investment-grade bonds still kind of struggling to recoup those losses from 2022. Now, muni bonds, on the other hand, they're more duration sensitive, so they do tend to be more tied to interest rates. And unlike credit spreads, this environment has not been overly supportive for the asset class. And this is particularly true if we look back to that fourth quarter of 2024.
Gotcha. So, with all of that said, where is the team finding the greatest opportunities today?
Yeah, so it's interesting. Based on what we've talked about already, I'm guessing you'd expect me to say municipals, but it's really across the board. So we're finding a good amount of opportunities in non-US equity funds, and even within taxable bonds, there are selective opportunities still trading at pretty attractive discounts. But it is really munis that look like a standout opportunity from here. So discounts as a whole trading at about 8.5% below NAV, and our average holding within our portfolios is going to be closer to 10% or 90 cents on the dollar. And then in addition, investors are currently clipping an average coupon of about 6.5%. And I know we traditionally view munis as most appropriate for tax sensitive investors, but at these kinds of yields, at these kinds of discounts, I think they look like a really attractive opportunity for those crossover buyers as well. And if we do see those crossover buyers start to come in, you could see those discounts tighten up pretty quickly.
All right. So ultimately, how does that translate into specific portfolio positioning, and what are and what changes did you make throughout 2024?
Yeah, so we've definitely taken down our overall closed-end fund exposure or positioning a bit, but we're still fully allocated within our muni sleeve. And then in taxable bonds, this is where the majority of that selling took place. There's a couple of reasons to be optimistic here, though. So first, we still own a number of funds that look attractively valued today. And then second, with our ETF allocation a little bit higher than normal, this should actually help play a little bit of defense if those spreads do eventually widen. And what it also does is it leaves us with a good amount of dry powder that we can quickly deploy if the discount environment becomes more attractive as we look ahead.
Gotcha. So let's think a little bit more thematically for just a second. And one narrative that we continue to hear, and it's only gotten louder over the last few months, has been this idea of higher for longer. And how does that play into your outlook for closed-end funds?
Yeah, great question. So, kind of two sides to this. So, thinking about taxable bonds first, it's not necessarily a bad thing as long as it doesn't start to impact the ability of those corporate borrowers to repay their loans. And at this point, I think there's kind of just a little risk there because we don't have that so-called refinancing wall because a lot of those borrowers locked in pretty low rates back in that 2020 to 2021 timeframe. And then additionally, if we think about corporate balance sheets, fundamentals, defaults, everything looks pretty strong at the moment. So near term, the risk is probably pretty low. Now, on the flip side of that, if you see rates tick up meaningfully due to a resurgence in inflation, story could be much different. But I think the former scenario is probably much more likely than the latter, especially in the short term. Now, in terms of munis, same applies in regards to a potential inflation resurgence. Obviously, not a great thing. But if rates just stay range bound or if they ideally decline, I think you could see some pretty attractive and potentially outsized returns here. You're clipping a coupon of 6.5%. You've got a good amount of downside protection because of that coupon with the potential to benefit if rates decline, at least on a NAV basis. And then most importantly, discounts are 8.5% versus a long-term average of 4. So you're potentially looking at double-digit returns over a pretty short period of pretty short to intermediate term time horizon if rates just remain where they are and we get a little bit of a help on the discount front.
All right, and last question. Based on everything that we've discussed today, do you think that now is a good time to think about adding closed-end funds to investors' portfolios?
Yeah, so if the question was, do you think today's a good time to add passive closed-end fund ETF exposure to a portfolio? The answer would probably be no. Closed-end funds are slightly cheap, but the segments of the market, in particular taxable bonds, look pretty pricey. Is it a good time to add a tactical closed-end fund strategy? I think is a more relevant question, and I would say yes for two reasons. So first, tactical strategies are able to take advantage of dislocations in the market and avoid those potentially overvalued securities that offer more downside risk than potential upside at this point. And this is basically what we're doing in our tactical income strategies. And then also long term, when we think about building diversified portfolios, it's great to diversify across asset classes, regions, styles, market cap. But including closed-end funds in the mix also provides the benefit of higher income as well as the potential to stack on that additional and unique source of return as discounts revert to fair value. And this just isn't something that you can typically get from a traditional open-ended mutual fund or an ETF.
Ryan, as always, great information. Appreciate you joining us today.
Yeah, happy to be here, Pete.
Should you have additional questions on this content or would like to suggest a future topic for an episode of Mic'd Up, please reach out to us at 426-4689 or via email at info@icm-invest.com. And be sure to check us out on YouTube, where you can like and subscribe to our channel to receive notifications of content just like this and much more. Thank you.